Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. The S&P 500 is clearly breaking through this big level and skyrocketing higher here in this melt-up type of move. In February 2023, we downgraded our S&P 500 target to 3,500 based on the idea that we are heading into a recession. Now the market is exceeding this high from February and clearly threatening the idea of a recession. The question is, where do we go from here? I'm going to show you why we're seeing a massive divergence between where earnings estimates are going right now and what leading economic indicators are currently suggesting, and why this divergence could be a dangerous setup for the market right now. I'm also going to show you evidence that inflation is proving to be a lot stickier than what many investors are currently pricing in, and why that could also be a big underrated risk for the market right now, given the extreme level of valuations of some of the biggest components of the S&P 500. Of course, I am going to give you the counter arguments to these risks so that you can make your own mind up regarding the market's next move and how you want to be positioned for the future. I hope you guys enjoy this video. Don't forget to smash the subscribe button if you are new here and click on the like button if you enjoy this video. Now, without further ado, let's get right into it. So in just a couple of charts, I can show you why inflation is actually proving to be quite a bit sticky. Now, of course, the inflation rate itself has gone down quite dramatically recently, simply because of things like commodity prices that have been plummeting. Since June of 2022, oil has come down a staggering 40%, contributing to this disinflationary force. But if you look at core inflation, you look at an indicator like personal consumption expenditures, which, by the way, is one of the Fed's favorite indicators when it comes to measuring inflation, it's not showing clear signs of moving lower. So when you take out volatile components like food and energy, it shows that inflation is actually pretty sticky right now and isn't really showing signs of coming back down. Not even like it did in the disinflationary periods, like here in 1972 and like here in 1975. You also have indices like this sticky price CPI from the Atlanta Fed, where they basically use a basket of items whose price changes relatively slowly, and it shows that inflation right now is sticky, and the stickiest it's been since the 1970s. So if we want to be data dependent, we want to pay attention to the facts, well, the facts are telling us that inflation is not dead, and in fact the Fed actually does have quite a bit more work to do before beginning to consider easing monetary policy. And more work to fight inflation could come in the form of continuing to raise rates, which we've seen is a bad thing for stocks throughout 2022, or holding them steady despite the fact that the economy is heading into a slowdown. And by the way, short-term rates do dictate where valuations are going. This is a chart of short-term rates, the 2-year yield against earnings yield, which is the inverse of PE ratio, so valuations. And you can see as rates rise, valuations cheapen, and as rates fall, valuations expand. That tends to be the case throughout most of history. That is the relationship that we have between valuations and short-term rates. So if we look at what PE ratios have done since September of 2022, well, we've seen them climb from 19 up to around 24. So we've seen a 25% expansion in valuations despite the Fed funds rate staying at 5% and underlying inflation dynamics not really showing signs of breaking down, which would be the only way that the Fed actually eases monetary policy significantly. It would be to see inflation come down substantially. And when you look at the biggest component of the S&P 500, which is Apple, and you look at its forward PE, the valuations of Apple, they're currently trading at around 27, 28, which if you look at the last 10 years of price action on Apple, it is in the 92nd percentile of valuations. We briefly saw Apple more expensive than this in 2020. And if I can quickly remind you where the Fed funds rate was in 2020, we were at zero. We had 0% interest rates. We had infinite QE. We had massive amounts of stimulus being injected into the economy, and that pumped up the valuations of stocks like Apple. Today, it's a lot more difficult to actually make the case for these expensive valuations. So that's part of the reason why we think the stock market is overrated right now, why there's much better opportunities out there than US stocks. There are stock markets globally that we do find quite interesting, but the US stock market is not one of them. There are a lot of assets that can perform extremely well in these types of environments where you have sticky inflation, you have the rising probability of a recession, assets like gold that just made a new all-time high, treasury bonds that are showing signs that long-term momentum is currently flipping, and there's even opportunities in stocks if you're willing to look outside of the US. These are all things that we do cover extensively on gameoftrades.net if you are interested in having a service that identifies investment opportunities with great risk reward, maximizing your potential reward over the next year, and staying away from assets that just carry too much risk. But let me give you the counter argument to valuations being too high right now, because if you look at 1999 to 2001, look at where earnings yields were. They were right here. So earnings yields, so valuations, were actually a lot more expensive than they are right now, right? And I can show you the chart of PE ratios instead of earnings yields. In 1999, PE ratios were trading at 33 here, and this was happening while short-term rates were at 6% and heading towards 8%. So you can see here in 1999, 2000, the market was much more rational than what we have today, with PE ratios at around 24 and the Fed funds rate at 5%. You can see here in 1999, the Fed funds was heading towards 7%, while valuations were hovering around 30. So this is a beautiful example of a full year or year and a half where the market was completely irrational, completely disregarding the discount rate because there was a lot of euphoria in the market at the time. And this is something that we've discussed in the past few videos. We have a lot of signs that we are in a 1999 type of environment with lots of euphoria around AI, lots of optimism on these stocks. And so if it went on for a full year and a half, 2 years back in 1998 to 2000, this could definitely last a little bit more like it did back then. Now, I have to be honest that this market rally hasn't just been about valuations. It hasn't just been about PE ratios expanding, because if we look at earnings estimates, we actually see that earnings estimates have been skyrocketing recently. Throughout 2022, earnings estimates were going down and contracting, and that was a big force that brought the S&P 500 down, especially in the second half of 2022. 2023 has been a story of actually an economic recovery being priced in before it even happens. And you can see this black line here is leading economic indicators. You can see that's still near its lows, still showing that we are heading into a slowdown, but earnings estimates are looking past that and saying, hey, this is not going to last very long. It's not going to go much deeper than that. And before you know it, we're going to see this massive recovery in leading economic indicators, and the economy is going to be booming again. So that can actually be the bullish argument here, that leading economic indicators are signaling a pretty shallow recession, that earnings estimates actually already priced in that recession. You can see we went down to the same level here as economic indicators, so all of it was priced in. And the market right now is essentially saying that's about as bad as it's going to get, and that we can actually look past this economic slowdown and begin to price in the cyclical recovery that will come on the other side of that. And that's actually a pretty good reasoning. If you don't think that we're heading into a recession and you think it's going to be incredibly shallow, then it's very possible that it's already been priced in and that the market is already looking past that. But the bearish argument here is that leading economic indicators here could still have further room for downside, and yet equity markets are priced in for perfection right now. So the risk reward here after this rally that we've had since September now into June of 2023, so the first half of 2023, after this entire rally, if we get any disappointment from an economic indicator standpoint. So equity markets are already anticipating a lot of good news right now. And if that good news doesn't materialize, if we don't see economic indicators begin to spike up here, and we actually do head into a recession here, or it's just a shallow but lengthy recession, then the entire rally that we've seen would get retraced and then some, depending on the size of the recession that we get. So this is the type of bet that we try and refrain from at gameoftrades.net. This is a big reason why we are underweight equities, because we just don't find equities very attractive right now from a risk reward standpoint. We're not willing to bet on a sudden economic surge here, because for now we don't see where that would come from. We've had no easing of monetary policy whatsoever over the past year. All we've had is the Federal Reserve tightening the yield curve, inverting, banks tightening their lending standards. And so it's difficult to see that we're going to see a massive cyclical recovery right now, despite these headwinds. I hope you guys enjoyed this video. If you did, don't forget to smash the like button and of course subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.